On January 30th, 1992, the SEC approved Enron's request to use mark-to-market accounting for its natural gas trading business, an idea championed by Jeff Skilling. Mark-to-market let Enron book the entire estimated lifetime profit of a long-term contract as income the moment the deal was signed, before a single dollar of cash arrived. It was unusual for a non-financial company to get this treatment, which is normally reserved for brokerages and trading firms. From that day, reported earnings and real cash flow began to drift apart. This alone was legal, but it was the enabling first link in everything that followed. Because Enron chose the assumptions used to value those future cash flows, it could manufacture today's profit out of optimistic projections, even booking predicted profit from a power plant still under construction. A Senate report later concluded the method appears in fact to have been abused by the company. When real results came in short, the gap between booked profit and actual cash had to be hidden somewhere. Each quarter needed a bigger or rosier deal just to keep the growth illusion alive. To hide the debt and losses the accounting created, CFO Andrew Fastow built a web of off-balance sheet special purpose entities, including Chuco in 1997 and the LJM partnerships in 1999. These vehicles let Enron move debt off its books and book gains on deals it effectively did with itself. The structures exploited a loophole. An entity could stay off Enron's balance sheet if an outside investor held at least 3% of its equity. By some estimates, this network ultimately concealed billions in debt across thousands of entities. Fastow personally ran and partly owned the LJM partnerships, named for his wife Lee and sons Jeffrey and Matthew, which meant Enron's CFO sat on both sides of deals that set Enron's reported profits. The board granted him an explicit exemption from its own code of ethics to let him do it. Fastow pocketed more than $30 million from LJM, later disclosing he had made around $45 million in total. Chuco, run through his deputy Michael Copper, paid him kickbacks on the side. The whole structure hung on a fragile technicality. Chuco never actually had the required 3% of genuine outside equity, because it was secretly funded with Enron-related money through Copper. That meant Chuco should have been consolidated onto Enron's balance sheet all along. That single accounting defect was the thread that, when finally pulled, would force the restatement that unraveled the company. The four Raptor entities, named after the Jurassic Park velociraptors, were the most dangerous trick of all. Enron transferred more than $1.2 billion of its own stock and stock rights, plus $150 million in notes, into the Raptors to create fake hedges against its volatile investments. This meant the structures hiding Enron's losses were backed by Enron's own share price. As long as the stock rose, the hedges worked on paper. The moment it fell, the hidden losses would come flooding straight back onto Enron. On August 14, 2001, after only about 6 months as CEO, Jeffrey Skilling abruptly resigned citing personal reasons, having previously sold roughly $33 million in Enron stock. Founder Ken Lay resumed as CEO and told the market there was no change in the company's performance or outlook. The architect of the trading model leaving without explanation spooked investors. The next day, Vice President Sharon Watkins sent Lay an anonymous memo warning that the company could implode in a wave of accounting scandals. On August 22nd, Watkins met Lay in person and handed him a detailed multi-memo analysis of the off-balance sheet partnerships Fastow had used to inflate earnings. Lay referred the review to Enron's own law firm, Vinson & Elkins, the very firm that had blessed the deals, despite Watkins flagging the conflict. Meanwhile, every external check stayed passive. The SEC had not reviewed an Enron filing since 1997, and all 15 major Wall Street analysts still rated the stock a buy. On October 16, 2001, Enron reported a third-quarter loss of $618 million and a $1.2 billion reduction in shareholder equity tied to unwinding Fastow's partnerships, including a $544 million charge linked to the Raptors. The hidden losses were now surfacing in public exactly as the stock-backed design guaranteed. On October 22nd, the SEC opened an inquiry and the stock fell to around $20. 2 days later, Fastow was forced out, and the Wall Street Journal exposed Chuco. On November 8, 2001, Enron restated its financials back to 1997, admitting it had overstated earnings by roughly $586 million. Consolidating the hidden partnerships brought about $2.6 billion of debt onto its books across 1997 through 2000, with roughly $628 million of that added for the year 2000 alone. A one-time charge was now revealed as years of systematic misstatement. Market trust collapsed. Rival Dynegy had agreed to a rescue acquisition of roughly $8 to $9 billion, but the deepening disclosures made that lifeline untenable. On November 28, 2001, two blows landed at once. Standard & Poor's cut Enron's credit rating to junk, and Dynegy terminated the merger. Because Enron's trading contracts and financings contain credit rating triggers, the downgrade instantly triggered roughly $3.3 billion in liabilities on a debt load of around $13 billion. counterparties stopped trading and demanded collateral, and the core trading business evaporated within days. The rating agencies had held Enron investment grade until just 4 days before the end. On December 2, 2001, Enron filed for Chapter 11 with $63.4 billion in assets, the largest corporate bankruptcy in U.S. history at the time. The stock that peaked above $90 was trading at about 26 cents. Roughly 20,000 jobs were gone, and around $74 billion in shareholder value was wiped out. Worst hit were the employees, whose 401k plan was about 62% invested in Enron stock and who were locked out of trading during a plan changeover as the price collapsed. Many lost 70 to 90% of their retirement savings, while Lay had sold about $23 million of his own shares that same year. Enron's auditor, Arthur Andersen, earned about $52 million from Enron in 2000, with more than half for consulting rather than the audit itself, a conflict widely seen as compromising its independence. As the SEC closed in on October 12, 2001, Andersen's in-house counsel directed staff to follow a document retention policy that triggered the destruction of Enron records. Convicted of obstruction of justice on June 15, 2002, the firm surrendered its licenses and collapsed, taking about 85,000 jobs worldwide and turning the Big Five into the Big Four. The Supreme Court unanimously overturned the conviction in 2005, but the firm was already gone, proof that reputational ruin can outrun the courts. A Houston jury convicted Ken Lay on all 6 counts and Jeff Skilling on 19 in May 2006. Lay died of a heart attack that July before sentencing, vacating his conviction. Skilling was sentenced to over 24 years, later reduced, and Fasto served roughly 5 years after cooperating and forfeiting about $23.8 million. The deeper response came from Congress, Enron, and then the even larger WorldCom fraud that broke months later together pushed through the Sarbanes-Oxley Act, signed July 30, 2002, passing the House 423-3 and the Senate 99-0. It created the PCAOB to police auditors, forced CEOs and CFOs to personally certify their financials under criminal penalty, mandated internal control audits, and restricted auditors from consulting for the same clients they audit. Each rule targeted a specific way Enron had failed. Strip away the partnerships and the trials, and Enron leaves ordinary investors one blunt lesson: be careful about concentrating your savings in your employer stock. The Enron workers were loyal, and that loyalty became a single point of failure. According to an Economic Policy Institute analysis, a worker who from 1980 had contributed 10% of average wages entirely to Enron stock would have lost about 94 cents of every dollar by 2001, while the same money split between bonds and an index fund would have grown by an extra $1.56 per dollar. Diversification is one of the cheapest forms of protection an ordinary investor has. It can turn a company's specific blow-up from a life-altering catastrophe into a survivable dip. And Sarbanes-Oxley is the reason the financial statements you read today carry a name and a signature behind them.